Awesome. Jeff, I'll let you take it from here. And then if people have questions or comments along the way, go ahead and put them in the chat. And Jeff, you can take those as they come, or we can get them at the end.
Okay, sounds great. I've got a few slides. I don't know if I'm able to share or not.
Yep.
Okay, it looks like I'm good to go here. Just let me know if these come up. All right, there. 10
Got
step
it.
fundraising success. Okay, well, awesome. Well, Spencer, thanks for inviting me. I'm excited. I always love talking about fundraising and startups in general. I'll give you a little background on me. For those of you that don't know me, I've been a founder, ran a company called Uppercase Living for about 10 years. We ended up selling that to a private equity group out of Dallas. And that enabled me to start doing some angel investing. I found myself tied up with the guys at Carta. It was eShares at the time when I joined, and they later branded to Carta. If you're familiar with cap table management company, they kind of set the bar in the early days. And as I was at Carta, I worked with a ton of founders, a lot of venture capital firms. And one of the things that I saw, well, there were two things that I saw a lot of founders struggle with. One was figuring out the equity and how that all works and how dilution works. And Carta had this solution that helped make that a lot easier for founders. Well, I came across these two founders that were going through Techstars, and they were doing something similar to Carta, just in the financial modeling space. So that was the other thing that I saw so many founders struggle with, is knowing their numbers, be able to figure out how much to raise, if it makes sense to raise, being able to project that out and really know their numbers when they go in and talk to investors. Well, again, that's what Forecastr was doing, is making that easy, taking the financial model out of spreadsheets into a software platform. So I ended up joining Forecastr about 3 years ago. And that is actually what we're going to talk a little bit about. Forecastr over the last 3 years has raised about $15 million, going down the venture capital path. And the last 2 years in particular have been probably some of the hardest or most challenging fundraising years that we've seen in decades. And I've been able to be part of and see how we've been able to execute on that. And I attribute a lot of our success to raising 4 consecutive oversubscribed rounds to the process that Stephen Plappert, the CEO of Forecastr, put together. And so that's what we're going to go through today. I'm going to run through these slides like really quick, and then we can dive into things on the Q&A. Spencer, I've got what, like 10 minutes or so?
Yeah, we can go till 10 minutes is great.
Okay, so about 10 minutes, and then we'll open it up for Q&A. But the two things I wanted to kind of separate this out into is you're preparing for a fundraise, and we're talking specifically kind of, that venture capital path of talking to investors, or an equity crowdfunding type of a fundraise. But really there's a preparation phase, and then there's the execution phase. And so that's kind of what we'll go through real quickly. And I've got a bunch of resources, so get your phones handy. I've got some QR codes that you guys can get some free resources on as well. To kick things off, here's your QR code. This is actually what we're going to be talking about, the 10 steps. It's a playbook. Feel free to download that for free. And this will kind of encapsulate what we're going to be talking about today. So, and we can have Spencer circulate that link afterwards as well if needed. All right, so step 1 is building an investor pipeline. So as you start out, this can be done, typically, ideally 12 months before you are actually going into the fundraising process. Getting to know or doing the research so you know who are the investors that could actually invest in your company. Who would you be a good fit for? So many founders skip this process and they just start, shotgunning. It's like, oh, we're going to talk to every VC out there. You're going to waste a ton of time. Do the research up front. One, it's going to show the investors that you know what you're talking about. It's like, we know why we're a good fit for your fund, and here's why. And when you build that pipeline, you can start to narrow it down. And this has a big impact when you get into the fundraising, the actual fundraising process and execution. So this is a critical piece and a place to start. You can use all kinds of resources out there, whether it's like PitchBook or Crunchbase. NFX Signal is probably the one that I recommend more than anything. Also Gust, AngelList. There's tons of them that you can do the research in advance. And then from there, you start that relationship building with potential investors. So identify, and then you start to build the relationships. One of the key things that I see so many founders miss out on is creating a habit to put out a monthly investor update. This is the easiest way to create and maintain relationships with investors. Every investor out there that you talk to will probably say yes if you ask them if you can add them to your investor updates. So now you've got an opportunity and their permission to send them a monthly update of how you're doing 12 months before you're going to even raise capital. So you're building a relationship here way in advance of when you're going to need the capital. Take advantage of this. I can't tell you how many times I've actually invested in companies after seeing them, execute and telling me every month kind of what they've been doing, and then just seeing the progress. And then when it comes for time for a fundraise, I kind of already know where they're at. It's a lot easier to make that decision when you know and you've been following them for months. In your monthly update, I just want to say, I know it's a pain as a founder because you got a million other things to do and a ton of fires going on all the time, but carve out an hour a month to do the update. And it can be really simple, just some bullet points that says, here's how we're doing. Here's what's going well for the company. So, some key wins this last month. Here's some challenges we're facing. And here's where we could use some help if anybody out there, has connections to this or, knows of folks that, could help us out. So super simple, but do it consistently and do it way in advance of needing to fundraise. Okay, so step 3 is where you start to craft your convincing narrative. And this is where you start to get your pitch. This is before your pitch deck, but you're trying to figure out what is the story? What's the vision? Where are you going? That's what investors want to hear and know about, is where are you taking this opportunity? Your story has to kind of have a hook of, this is what the problem that we're solving, and this is why we are, worth following and watching. Crafting this pitch, you're going to use it a ton. And so again, this is, 6 months out, you're crafting this. And, and a lot of these things are, the vision of how you're going to get there or where you're going. And then if you can start detailing out, here's how we get there. And this flows into, being able to know, who you need on the team, starting to develop some traction, know your customers, all of those types of things. This all fits into your pitch, and it will get better and better over time. And so start crafting it and improve it as you go. And this flows right into the step 4, which is knowing your numbers. This is something that's a key element. Like I said, most founders struggle with this. So, don't get frustrated if you're not a finance expert. One thing I do tell founders is that realize that most founders are not finance gurus, but almost all investors are. So they're not going to expect you to necessarily, be a finance expert and be at their level. But what they will expect is you to be able to speak the language. And it's a weird language, especially in the startup space. As you start to raise money, it's kind of this weird dialect of finance that they speak. And there's a lot of acronyms, your ARR or your MRR, and what is your ACV, your average customer or average contract value, your CAC, LTV, all that stuff. Knowing how to speak their language helps to build confidence in your investors, but it'll also help you have confidence. And the way that you do this is you figure out the key metrics that matter in your business and you build your model accordingly. And that's how you figure it out. By building your financial model, that's how you're going to know your numbers. And so this is again where Forecastr comes in. This is what drew me to Forecastr, because I saw this was such a challenge for so many founders. And Forecastr makes this easy. We assign an analyst, they put everything into a software platform that connects to your accounting system, pulls in that data. So now in your monthly investor updates, super easy to share your metrics with your investors. You can just get it down. So, I mean, that's why it only takes an hour a month to do your investor updates. So that's an example of Forecastr. I did want to just give a quick shout out. Forecastr and Summit Venture Studios actually has a relationship here, and anyone that's part of this, if you go through Summit Venture Studios, you can actually get a 20% discount. If you're a founder that has over 100,000 in revenue, click here and go through a quick demo. It will definitely be worth it. If you're kind of in those early stages or pre-revenue kind of, I've got some free financial modeling templates that I think would be super helpful for you to at least start to build out the guts of your financial model. So take advantage of some of those resources if that would be helpful. Okay, step 5, still in the preparation phase here, is create your pitch deck. And one of the only thing I'll say here, we've probably done tons of sessions on your pitch deck and all that, but one of the keys that I've seen is to keep it simple. Treat the investors like they're in 5th grade. So that they can understand what your problem is up front. Spend more time on your problem than on the solution, which is hard for founders because you're so excited about the solution that you've come up with. But make sure the investors understand the problem you're solving, they get it, and then you can go into why what you're doing is so awesome. So I'm going to also give a quick shout out to Tim Cooley, who I believe is part of this community. But Tim is the author of the Pitch Deck book. If you're crafting your pitch deck, I would highly recommend reading Tim's book. It will help you figure out what you need in your deck, just so you're not missing some key elements that investors need to know. I've honestly seen founders leave off like key things, like even the ask. It's like, I don't even know how much you're needing or what it's going to be used for. So make sure you've got everything in there that you need. All right, I'm going to hit these last ones really quickly, but having a good data room is super critical. Again, this is a way for you as a founder to prepare and put everything in a nice organized fashion so that when an investor asks for something, all you have to do is send them a link to your data room and it's all there. Your confidence as a founder is going to go way up if you're prepared with all this information in advance. And it's going to increase the confidence of your investor when you don't have to go back to your attorney and go, oh, do we have IP assignment agreements? We've got to get that done. That's not a good sign for the investors, for one, but it also kills the momentum when you can't just give them what they need right away. And momentum is a huge part of the process, which is what we get into next. And this is the execution phase, where you start to schedule your investor meetings. A lot of this is detailed out in the fundraising playbook, but and so we won't dive into this too deep. But I did want to say one of the things I've seen Steven do, who's the CEO of Forecastr, do extremely well, probably better than any other CEO I've seen in fundraising, and I've seen a lot, is run an effective process, creating momentum and urgency with the investors. So a couple of tips and tricks here. Your fundraise, you don't want it to run over the course of 6 months. You want it to be like a 4 to 6 week period that you open up. You've done all the prep. 12 months out, you've done all the prep for this. And then 4 weeks in advance, now you start to book these meetings saying, hey, we're going to open up our round, next month. It's going to run from February 15th to, March 15th or something like that. And we would love to get you guys on the schedule. It creates an urgency for the investors where they're like, oh, if we want in on this deal, we've got to take a look. We've only got a month. it gives them enough time to figure out schedules and all that. But at the same time, you're putting the pressure on. It's like, hey, one of the biggest things that you can take advantage of with investors is FOMO, fear of missing out. So take advantage of that, put a tight time frame. The other benefit that that creates is it creates this momentum. There's a huge difference when you've got 3 to 5 investor meetings per day than when you've got one, and they're the only one you're talking to. Your confidence is way higher when you know that you're talking to Andreessen Horowitz next, or you're talking to Kickstart or somebody else after this one. Your confidence goes way up, but they also naturally feel that confidence and feel that, oh, you're talking to somebody else after this. We better take this serious. So anyways, a couple tips and tricks there. Hope that's helpful. And then I'll just hit on the initial pitch. Something to do here is as you go into the pitch, know the investors. So do the research in advance, know who you're talking to, create those relationships. Hopefully you've already created some relationship before you're going in, and this isn't the first time you've met them, but knowing who you're talking to, super important. And then having you have to set the tone of these meetings. Like, you bring the excitement, you bring the energy, and that's a critical piece of all of this, because they are looking at you as a founder, and they're making an investment typically in you. We kind of talked a little bit about this, but building a momentum, you can kind of do this by setting the time frame. But one of the advantages Stephen had in actually all 4 rounds is he had a fantastic co-founder named Logan. Logan could kind of run the business while Stephen focused on fundraising. Stephen moved out of the office for 3 months in preparation leading up to this, and he tried not to get distracted. He let Logan run the business, and he focused, as suggested here, 80% of your focus is on fundraising. This is kind of a full-time gig if you're serious about it. So minimize your distractions. This is super hard for solo founders. Having a good solid team is critical here. Not always possible, but just realize that fundraising is going to be a full-time effort. One last thing I'll mention on this slide that I think is important is, as investors, talk about terms initially as you're building the momentum. You don't have to get into the specific terms, especially, if you don't have a lead investor. When they ask, what are the terms, say, hey, we're looking for fair and reasonable terms. If assuming that is in place, is this something we would love to have you on the cap table? Is this something that you'd like to consider? And, I think that works, especially as you can start to build soft commits. Say, hey, can we put you down as kind of a soft commit if the terms look reasonable and fair? And then you can start to build that momentum that way, saying that, hey, we're raising, $1 million, we've got 500 soft circled, where they're kind of soft commits. It helps with that momentum. Finally, and then we'll get into Q&A here, is as you're closing the deal, you've got to make the ask. I saw Stephen do this very personably, but very direct. And it's like, hey, we would love to have you guys on the cap table. What are your thoughts? What would it take? And just being really direct with them and letting them know, here's kind of, the timeline, and we would really like you in. The other thing that I saw Stephen do really well is there's kind of this, when somebody says, yes, we're in, it's kind of like, yes, there's a celebration, you feel like celebrating. But it is important for you to keep your foot on the gas of the fundraise, not get distracted saying, oh, now I can go back to running the business. Until the money is in the bank, you have got to keep pushing on the fundraise. Don't lose somebody that's committed because you're not following up and because you're not getting getting all the information over that they need. You're going to go through the diligence process, keep the foot on the gas on the fundraise, until it's done. Okay. Again, here's the QR code. We went through this super fast. This is a great resource. I will tell you, I've shared this with so many founders, and they have followed this, and found it extremely beneficial. So if you are going down the path of fundraising, take advantage of this free resource. I'll share one other resource with you guys. This fundraising benchmarks for early stage startups. So as you start to figure out kind of where you need to be raising a seed round or raising a Series A, there's a QR code here for a fundraising benchmarks for early stage startups, resource that we put together that may also be helpful for you. Okay, so with that, we
It's
can
awesome.
jump in Q&A.
That was awesome, Jeff. Yeah. So if you've got a question, come off mute. Ryan put one in there. Ryan, do you want to ask it?
Sure. So a lot of these pitches or these presentations that I hear, they're kind of tech focused because that's what most startups are. But are these same principles like the 10 steps to fundraising? Can they be used in other industries? Med tech, medical device, manufacturing, product based, CPG, that kind of stuff, or does it need to be tweaked a little bit?
Yeah, great question. I think you always need to tweak things. I mean, a medical device or a biotech company, for example, it needs FDA clearance and all that stuff. It's going to be a slightly different process just because, but at the same time, you're going to still have to do the things up front. You still need a good, clean data room. You still need to build relationships with investors. All of those things definitely play in. You're going to know your industry, your market better than anyone. And so if there are things that you do need to tweak, I think that'd be obvious, but most of this should be fairly consistent, whether you're a CPG company or a software company, marketplace, whatever. I think where you do find some differences, your financial model is going to be significantly different on all of those. And so being able to craft your story and knowing the metrics that matter for investors, that's going to be different for each company. So your metrics, if you're a medical device company, the metrics that matter are very different than a SaaS company. So those are things where, your financial model again comes into play, and knowing your numbers, knowing the metrics that matter and what you can share with investors to get them excited.
Jeff, don't you find though it's pretty much ubiquitous, regardless of what vertical or channel, that you've got to establish the relationship with that investor? You've got to identify the investors, and it's not just a random thing where you've got everything prepared and now you're trying to establish it. Without that legwork, you're kind of screwed.
Yeah, for sure. That's something that's going to be consistent across the board is creating the investor pipeline. The preparation stuff is all very applicable. There might be some nuances and differences in terms of, the investor research. Maybe there's different resources you can use for that in different segments that is better than for others, but it is critical. So I totally agree with you, Joel.
I had a question about founders actually investing in subsequent rounds, or how they talk about, skin in the game versus sweat equity. How important, what's the balance, Jeff?
Are you talking about the founders investing
Yeah.
in the next round?
Founders, yeah.
Yeah, interesting. I think that, I don't know that I don't see founders typically putting out money in the next round. What you might, I think the question here is the amount of equity the founders have. What investors are going to be looking for is, do the founders have enough equity to make it incentivizing for them to get this across the line, to get to the exit scenario? If you're raising a Series A round and you've already given up 50% of the company as a founding group, that it could raise some red flags. They're like, oh man, if we have to go through 4 more rounds of funding, at some point, do the founders start to lose incentive because they're so diluted? And so that's where, you want to have a good cap table management solution to be able to kind of figure out the equity dilution. And here's where founders get into trouble, is when they start stacking safes or convertible notes, and it's not super clear how much of the company you're giving up. when you raise that round. And so by the time you actually raise a price round and all of those notes or those safes convert at whatever terms they were, maybe there's a low valuation cap or something, all of a sudden the founders, I see it all the time. The founders raise a Series A and they're like, what? We didn't know we were giving up that much of the company, because all their safes and everything convert. And they're like, wait, where did that come from? If you've got a software that managing your cap table, you can run those scenarios in advance and go, okay, if we raise $10 million, what does that do? Everything's going to convert. What does that look like? How much equity do we end up with at the end of the day? What does our cap table look like on a pro forma basis? So that's where I think the founder equity starts to, matter.
Awesome. What other questions from the crowd?
Well, people are being shy. I'll bring up a question, Jeff.
Go for it, Joel.
In all the vetting that you've done in the angel investing since your exit, what's the craziest idea that you thought wasn't going to work that did?
Oh, I've got one just the opposite. One that I thought would work that didn't. I've got plenty of those probably.
Either one's fine.
One that did, the craziest idea. I mean, normally if I think it's a crazy idea that's not going to work, I'm probably not going to invest. And so it'd be probably some that I missed out on. One that has kind of surprised me, I guess, is I invested in a space company called Evolution Space. And I had no business being in this. I kind of got into it because some friends said it was a really good deal and all this. And they've done extremely well. Had some big DoD contracts and stuff like that have materialized. It's something I feel kind of lucky on, I guess. So I don't know if that was a surprise. It probably was a surprise at some level of how well they've done. But on the flip side, I think there's a lot of instances where I thought something was a great idea, and it didn't end up working out, whether it was founder issues or whatever else, but they couldn't execute on the idea and it failed.
Thank you.
Spencer, I've got one more thing. I just saw this morning that Utah Business released an article I just wrote about 5 tips to confidently raise capital. It hits on a lot of the things we talked about, but here's a QR code if anybody wants to reference that, or you can just go to Utah Business. I guess they released it this morning from what they told me.
Awesome.
So feel free to use that as a reference also.
Very cool. Okay, we got time for maybe one more question. Don't be shy. Joel said, don't be shy.
I got one. Jeff, I saw a post from someone this week about all the momentum in the Utah community. From your perspective, what's that momentum like? And as we push towards, the 10-year goal of the Olympics, what do you think is in store for us?
Oh man, I'm super bullish on Utah. Love the community here. We have a unique thing. I go to a lot of different ecosystems. So we have our founders and funders events, and we'll take these to Austin, to New York. I'm going to New York next week for one. And we just got back from Tampa and did one there. So I see all of these ecosystems. The unique thing about Utah is over the last 30 years, we have been building this ecosystem. People don't realize that this isn't just something that's happened in the last decade. This is a 30 or 40-year, process. Joel totally sees this. But I mean, this started back in Novell and WordPerfect and that. All of that has contributed to where we're at now. And we're in a unique position to have all of these founders that have had successful exits now. I think per capita, I believe we're still like the top ecosystem for having successful unicorn exits on a per capita basis. That is significant. You go to other ecosystems and very rarely do you find like a big, unicorn type exit in a lot of those. So now what that does is, one, it creates a lot of wealth in entrepreneurs or future entrepreneurs. And so that starts to snowball. And if you see, like, look back a few years ago when we had, Divvy went through a big exit. You're starting to see all these guys from Divvy that are now starting their own businesses, right? They have an exit, they've got some capital, they've got the experience, they've seen how it's done, and then they've also got the network because their friends all went through the exit too, and they've got money and they want to invest. All of this snowballs, and I mean, you're going to see it just get bigger and bigger as we go. And I mean, I don't know how the Olympics kind of fits into this whole scenario, but I am super bullish on the next 10 years in Utah leading up to the Olympics, which I think will just put a bigger spotlight on everything that's happening.
I appreciate that. One from left field. As a skier, are you hopeful or concerned for our snowpack's future?
Oh man. Yeah, I've been to a bunch of events. I've got a good friend who is very close with like the POW folks, the Protect Our Winters. Um, I mean, I'm kind of concerned, honestly. I think there's a lot that we should be doing. I was actually kind of bullish on it when during COVID, it was like the air quality was noticeably different. So I think one thing, I mean, if everybody went to EVs, maybe that would help with the environment. But then the whole Great Salt Lake thing, there's some things to be concerned about. I'm still hopeful for another good winter though this year.
Thanks, Jeff. This is awesome. Thanks everyone for coming in. We'll see you next Tuesday right here at 11 o'clock Mountain.
Thanks for having me, Spencer.
You
Great
bet,
job.
guys. Awesome community.
Thanks, guys. See ya.